Welcome to the Infra Insider podcast from Infra-Be, a leader in renewable energy and infrastructure executive search. Join us as we dive into insightful conversations with industry leaders, pioneers and visionaries shaping the future of infrastructure and renewable energy. Discover the latest trends and innovations and challenges driving the transition towards a greener and more resilient future. Please remember to like and subscribe. Welcome to the Infra Insider. This is episode 11, and today I'm joined by a wonderful guest who, I don't know why, she always brings a huge smile to my face. And I think as you watch this podcast, you'll see what I mean. Today's guest is Maria Di Marzio, and she is a senior director at BayernLB, and she focuses across debt, of course, working for a bank, specialising across infrastructure and renewable energy with a real focus. She's nodding. She's like, "Is that right?" With a focus across renewable energy. I'm sure she'll correct us. But Maria has had a really interesting career, because she's worked within banking, and she's also spent a period working in-house with a European renewable energy developer. And I think that's quite unique. Seeing it from both sides. Today, we're talking everything debt, project finance, and we're going to clear up a few interesting things. But of course, it's very pertinent at the moment because interest rates, if you hadn't noticed, your horrific mortgage payments, they are sky high. So how's that affected the marketplace? What are the nuances? What are other developers doing? What are other IPPs doing? And that's what we're going to cover off today. Maria, welcome.
Thank you, Dan. Thank you for inviting me, and I'm very pleased to be able to share my experience in the renewable energy space.
Thank you so much. We've been trying to get this together for some time. You're a bit hesitant, but I can understand why. But I know this is going to be a great conversation. Maria, being recruiters, we're obviously always so interested in people's careers. Can you talk us through, how you got to where you are today?
Sure. So where to start? And I think inevitably I will have to give it away how old I am in this process, but that's okay. So I've joined project finance in 2007, and I was coming from a couple of years of acquisition finance in the UK. And when I joined project finance, I wasn't too sure whether I was going to be allocated to infrastructure financing or to renewable financing. And unfortunately, I was originally allocated to infrastructure financing. So my background includes also 9 years of infrastructure financing. But having said that, my knowledge and experience in infrastructure financing have become very relevant today. And this is because my experience with the tender process for public assets, and as well as my familiarity with the provisions in the concession agreements, are quite relevant today, where we are looking to energize the transportation sector. And I've been involved, for example, in supporting clients for the operation of electric buses across many cities in Europe. And as well as, for example, now we have many municipalities which are tendering PPA contracts for them to offtake the electricity for some of the PV plants which are near the city that they manage. So the infrastructure aspect has become quite relevant for me in the very recent past. Having said that, I think my true journey in renewable finance started in 2016, and since then I've been predominantly doing renewable financing, and I've been involved with the project financing of PV, onshore and offshore wind, and more recently also battery storage. I would say that I have seen the full spectrum of revenue streams from the ROC regime, the feed-in tariffs, the green certificates, the continental energy in Italy, the EEG in Germany, and also the shift to PPA financing and as well as merchant financing. So I have seen the full spectrum of financing structures, and I was very fortunate to work also on very high profile transactions in Europe. And I would say that I was also very fortunate to work with exceptional individuals which I look up to, where I've really learned a lot from, and also for employers which have given me the space and the support to develop professionally over time. So a bit of luck and a bit of goodwill, and a good array of opportunities to learn from.
Well, they say you make your own luck, but no, it's interesting to hear that you've been involved sort of for 8 years, since 2016, and over that time it's probably gone like this. When we look at the trajectory, how do you think the current state of the debt markets for renewable energy projects are across Europe at the moment? You talked about trends there, the ROCs, PPA financing, all of those kinds of things. So what shifts are you observing now that are quite unique to the current market?
Mm-hmm. Sure. So I think the current market is a reflection of what has happened historically. So to be fair, if you ask me, in my personal opinion, I see really 3 periods, i.e. the period pre the financial crisis of 2008, the period post-financial crisis of 2008, and the period post-COVID and post-Ukraine war. And so if we look at the period pre-financial crisis, I think around 2000, 2005, 2010, there were lots of subsidies being introduced by various countries offering a very high tariff. The objectives was really to reduce the greenhouse gases by 20% and to increase the energy mix by 20%. So the market at that time was really buoyant because the subsidy regime really provided a high level of fixed revenues within the structure, and they were highly financeable. Then we came to the financial crisis, which lasted over a cycle of maybe took around 10 years, I would say, to get out of it.
Are we still? I think we're still in it, aren't we?
Potentially, yes. And in the UK, we're not even considering we had Brexit and COVID that came afterwards. But yes, we are still somehow within it. And therefore, we saw the government really struggling with the balance sheet and supporting supporting renewable energy and the new implementation of renewable energy. So for a period of time, the market was quite stagnant, and the subsidy regime came to an end, were stopped, or there was simply no new capacity being tendered. So during this period, we've seen really the PPA market advancing, particularly from Spain and then to the rest of Europe. And to some extent also merchant financing being available in the market. Now, where are we today? I think since the war in the Ukraine, the targets are of course to shift to a net zero economy by 2050, so to electrify all the transportation and the heating market, but at the same time energy independence had become an intrinsic target for each of the countries. So what we see in the recent years is many of these countries renewing the subsidies or looking to renewing the subsidies. So the UK is continuing with the CFDs. They've introduced market for battery storage 5 years ago, and it's the same for Italy, where they have the new FAIR 2, FAIR X that will introduce, and also the MAXE for the battery, in addition to the capacity market that they had already introduced before. Poland is looking to again reopen the CFDs, and Romania, for example, is in Romania and Greece are in the same boat, where they are introducing CFDs for the first time in the market. So there is a need to make sure that we do transition to a net zero economy by 2050, but there's also a need to become energy independent, so not reliance on the oligopoly market deriving from gas, for example. So we see that there's a lot more support for the subsidies, and of course I think the subsidy play a role because it makes those projects from a debt perspective, senior debt perspective, a lot more bankable. But we can say also that the subsidy is not as generous as before. So we used to see the 300, 400 euros per megawatt. Now we're talking about 65 to 85 megawatt per hour. And it's a different market. Of course, the cost of the technology have come down, but still they're not providing as much as fixed revenues as possible. So there is a market for PPA as well, because if the CFD has not been allocated or is not yet present in the market, somehow the project has to be financed. Of course, not all developers have the equity to finance this projects on balance sheet, and therefore, the PPA market and the merchant financing are really still playing quite a role in Europe. I would say more the PPA market than the merchant financing, in my view. We've seen merchant financing being predominantly active in Spain, but Spain slowly withdrawing because too much merchant risk has been put in the books. And therefore, between the CFDs and the PPA contracts, they're there to support the implementation, the penetration of new renewables in the market to date. So I guess where is the debt market? There's a lot of competition.
Yeah.
The banks have a big role to play, and the competition between themselves, of course, but also from the debt funds and also from other source of equity, which could be capital raising, or we see also developers joining ships and putting equity together to make a project to realize a project. So it's an interesting market.
So would you say that debt financing for renewable energy projects has been more difficult over the last sort of 12 months?
I would say it was probably more difficult at the time where the subsidies were somehow not renewed, or there was no new capacity being tendered, because it created a period of time where not every country was ready for PPA, not every lender or lending institution had the appetite for merchant financing. So there was a period between 2000 and I would say 16 to early 2000 where the market was a bit more difficult than we've seen previously.
So you talked about subsidies, you talked about CFDs. I'm assuming these obviously make a renewable energy project more attractive. What else are you looking at when you're looking at the creditworthiness, of a project? And also, are there sort of any regions or any sort of specific technology factors that play a role when you're looking at projects?
Sure. So I think generally speaking, it's probably not the most important part, but having an experienced sponsor is always a good starting point because you want someone on the other side which understands what a project finance is, what can be the asset during the tenure of the loan. And then I would say technology. Typically, the technology has to be proven, and of course, it's easier to say now for PV and onshore and offshore wind. But now we see, for example, battery storage, carbon capture, green hydrogen. I mean, to some extent, the technology is not completely new in some cases, like the battery storage. But for example, the revenue markets for battery storage are not established in all of on the markets, and the capacity market might be really a very minimum level of guaranteed revenue, so they don't provide the same protection as some others subsidy regime have provided before. So yes, I mean, technology, proven technology, and then revenue streams. As I said, I feel for a lender, the more fixed revenues you have, the better, typically speaking. But also from a lender perspective, we understand that developers and investors shouldn't leave too much money on the table. Should be given a little bit more flexibility in that respect. So, but a good level of fixed revenues, or otherwise, where the market requires it, merchant financing is also possible. But for example, I've been dealing with project finance only on selected countries, selected technologies. So each lending institution might have its own criteria for fully merchant financing structures. And then I guess, yes, you have to be comfortable who the entity which is going to build the project, whether they have experience, they have reference plants of a similar size elsewhere or in the country itself, who is going to operate the asset. So similar reasoning, experience, and reference plant. And then it's down to also getting comfortable with the financing structure. And when I say this, because of course each lending institution will have its own appetite and its own criteria. But it must be a financing structure that reflects the risk that you are facing. So how much merchant it is, what kind of technology is used, how predictable the revenues are, and so forth. So we're starting, for example, from a sizing tenor. So looking how much, what is the tenor that we want to look to size the debt. And this varies between technologies. And then, of course, your cover ratios. And this really measure, the risk that there is in a transaction. So how, if you have fixed revenues, you might have lower cover ratios. If you have variable or merchant revenues, you have higher cover ratios. And yes, and I guess within that, sensitivities analysis and break-even analysis becomes quite important from a lender perspective. And this is really an important measure of how low your energy prices can go before your revenues are equal to your debt. I said it in a very simplistic way. So how much resilient is your project to any downwards movements in your bottom line, which could be due to lower revenues, higher operating costs, and so forth. And then I guess as a resulting of the cover ratios, of course, is how leveraged the transaction is. And this is really measures how much equity the developer, the investor is putting in the project, because ultimately they will be repaid a lot sooner than the senior debt that we will put in place for a project financing, which could span between 10 to 20, 25 years, while the equity typically after 5-7 years they are fully repaid. So it's a combination of all of these points. Yes, and I would say again, each market is different and comes from a different history. And again, as I said, if we take the battery storage as an example, the UK created a market for battery storage with the capacity market and all the ancillary services, and therefore was easier for battery storage project to become bankable in the UK. Now Italy is following suit, and I'm sure other European countries are looking to introduce some subsidy to allow the deployment of battery storage in Europe. So I would say it's not, it's a mix of what's available in the and lender appetite, because you will see maybe, I don't know, lenders who have financed battery storage, for example, in Italy, there will be more, they would understand the technology and the risk of this of the project more, and therefore be willing to finance this technology also in Italy, for example, or elsewhere, having that knowledge.
So in general, it sounds like there's going to be some quite positive changes across Europe, which will obviously help soften the market. Something that hasn't softened though is higher interest rates. I mean, look, interest rates are interest rates, and I think that there's definitely some, you know, I suppose the market's now got used to them. But what is the effect of these higher interest rates, you know, on projects, and has it had a very negative impact?
I would say that in the last, I think there was a turning point sometime this year, and this is because the economy or the financial markets, to be more precise, recovered a lot faster from the geopolitical instability derived from the war in the Ukraine. So I think prior to the war, for a couple of years, also due to the COVID, what COVID has brought to the world economy, we saw base rate even being in double digits across Europe. And also the financial instability and volatility in the financial markets, that meant that the bank's own funding related cost was increased. So this, to give you just a scale of the issue, a couple of years ago, this could have a project with a all-in rate between 8 and 12% on average. So it's not something that would have make a project very attractive for an investor, and also because typically you can find other source of equity which at lower costs. So and this could be via, as I said, equity on fund, to the extent the investor has his own fund to build a project, or raising equity through the capital markets, or other type of lending institution like the big funds, so the debt funds, the pension funds, the insurance funds, which have access to these long-term cash flows and can lend quite cheaply in the market. So there was I would say a slowdown in projects to a certain extent, because of course developers which didn't have their own fund had to find a solution, and if the solution was more expensive, sometimes they did also finance the project. But of course that came with a bit of cost, with the intention, of course, to refinance as soon as the market condition were more favorable. I mean, we've seen a lot of hard mini-perm structures. These hard mini-perm structures are basically sizing against the normal tenors, but doing a legal maturity of 7-10 years to allow effectively a lower cost of funding, and therefore projects to be financed on a project finance level. So I think that was a couple of years ago. What I would say that now base rates are still high, but in the region of 3.7 to 4.5. I think there are some outliers, like Hungary is probably still 7%, but they're more, let's say, affordable, and with the bank on cost on top of that, on margin, credit margin, they're still quite, at the same level of competitiveness to other sorts of funds. So I would say the market is, especially, I mean, from my own personal experience, the last 6 months have been really, really active, and I've been seeing lots of requests for project financing, which is really encouraging.
Yeah, that is encouraging to hear that the market is still busy and buoyant. Something that I wanted to cover off, and just something that I want to talk about a bit further before you go. So PPAs, we've mentioned them, a couple of times. Obviously, they have a very, very big role to play in project finance. how crucial are these? I mean, obviously, you talk quite a lot about sort of the long-term revenue streams, but how crucial are they, and is there any changes ahead?
Mhm. They're still quite crucial. I mean, some of the subsidy schemes are not yet been introduced. They're still through the government approval process in many European countries. And also the CFDs are not there for everyone. So each developer is allowed to bid, but you never know whether you get one in practice. And therefore, there's a very the PPA are providing a significant level of protection or comfort for banks in order to finance transactions. I mean, they come in all sorts of forms. I mean, we can range from the PPA from the utilities, from the large traders, from the virtual PPA with the large corporate of industrial consumers. So there is, the market has evolved and is definitely providing alternative ways of financing transaction. Of course, they tend to be still in the region of 10 years. And the lender is asked to take tenors of around 20 to 25 years to finance some of these projects. So there's still a very much large element of merchant revenues in the revenue structure of this financing. And of course, this is reflected in the financing structure and the leverages that are achieved under this project. So, for example, if we look at fully subsidized project, you probably have a leverage of around 80 to 90%. If you then look at the PPA finance project, you are in the region to 70, 75%. So it's of course it comes it implies that there's more equity to be put in a project. But I think it's a very good alternative, or it's the next best alternative to a subsidy.
Yeah. So you talked about equities, and one of the credit worthiness of a project is obviously revenues, but also how much equity someone can put into the project. But on the other side of things, it has obviously been more difficult to raise capital. Are you seeing lenders coming to you with less equity available these days?
So it's a difficult question to answer because it really depends on the profile of the investor. So you have very large investors which have the pockets full of money, and you have relatively smaller investor or investors which have a large pipeline, but they still have not fully developed an equity strategy. So they're reacting to opportunity and as and when they materialize. And I say this because, of course, the planning process for this project is very long. In some countries, it can be even 7 years long, if not more. So, it's difficult from a developer which doesn't have its own money to actually tie someone else in or get access to the money and then funds are sitting in an account and not really working hard for them. So we see different solutions. I mean, we see, as I said before, developers coming together and becoming equity partners in projects. We see developers, of course, to the extent they're listed or not, trying to raise capitals by the capital markets and so forth.
Okay, it sounds like there is a lot of positivity in the marketplace. You're still busy, people are still looking to develop projects. There's still some equity out there. There's clearly some subsidies coming through. There's lots of changes coming through. Hopefully government policy continues to favour renewable energy. It looks like it is. So look, there's continued growth. Things are looking positive. What are your final thoughts on the next 6 to 12 months? Is there a particular country that's going to do better? Is there a particular technology that's going to do better? what is your kind of conclusion of the sort of near future?
Listen, I always think that one could retire in renewable. Okay, so there's no end to this market, and specifically because the transition to a net zero economy implies that the existing plant will be repowered or replaced, and new projects will be introduced. New technology will be developed. As we said, we mentioned battery storage, and I know that many developers are now getting planning permission for like PV plant and battery storage, regardless of whether they will implement the battery storage or not initially. So, I mean, there's carbon capture, there's green hydrogen, if we can sort out how the transport of the green hydrogen. But yes, and the infrastructure for it. But yes, that there's there's a lot more to come. Some of this technology, I'm sure they will take off quite quickly, like battery storage for sure. And I would say that the markets which I see most active at the moment continues to remain the UK, Italy, certainly Poland, Romania, for example, where there is 8 gigawatt in development already, ready to build, approved. Greece is moving ahead now with subsidies. So, it's those countries which are taking the steps to ensure that the penetration of renewables increases, and at least for the next 6 to 12 months or more, if that makes sense.
No, it makes perfect sense. I've really enjoyed the discussion today. I think you've shed a lot of light on a lot of different aspects, and also just taking us through your journey. And of course, yes, since 2016, it's been renewables, but you've obviously also come through infrastructure and those sort of PFI, PPP style contracts, and how it's all evolved. And I think it'd be interesting to pick up this conversation in a couple of years' time. But one thing that I've taken from this is the renewables market is continuously evolving. And like any market, there's always going to be brick walls, but it seems like the market's leaping over them, and the renewable future is bright. Maria, loved having the chat. Thank you for joining us, and enjoy your trip to Milan. I hope you don't do too much shopping, and I look forward to catching up with you soon. Thank you so much for coming on the show.
No, thank you very much, Dan. It was a pleasure.
Fantastic.